Hello, and welcome to the Logistics Management Podcast Series. My name's Jeff Berman. I'm Group News Editor for Logistics Management Magazine and the Peerless Media Supply Chain Group. Today, it's a real pleasure to welcome back Dr. Walter Kemmsies to our podcast. Walter serves as principal of the Kemmsies Group. If you've not heard Walter's name before, well, actually, if you have heard Walter's name before, it's for good reason, as he's one of the leading global trade economist that's actually out there. And he's an expert on ports, rail, and infrastructure in the United States. Other areas of expertise include demand forecasting, maritime and overall global trade, regulatory issues, public and private port and infrastructure financing, and long-term strategic planning and capital investment. Walter's worked in major cities all over the world and has a very global perspective, which uniquely qualifies him as a global trade economist. He also currently advises several major United States port authorities and is routinely asked to work on complex issues with various investment banks, private equity firms, and public regulatory industries. He also provides substantial support to the freight movement industry via the publication of port volume data for the American Association of Port Authorities, as well as presentations at major international industry conferences, and also advises the U.S. Department of Commerce on supply chain competitiveness, the committee. And he also recently testified to the U.S. Senate Transport and Commerce Subcommittee on issues affecting the freight industry. Hey, Walter, welcome back to our podcast.
Hey, good morning, Jeff. It's great to be back.
Absolutely. I believe this is your second or third time here on our podcast, Walter. So we'll just hop right in. We have a lot of ground to cover in a fairly short time. Why don't we just start with the obvious, Walter, which would be the freight economy. Obviously, there's a lot going on when we look at GDP, employment numbers, inflation, but I'll just kind of pass the ball to you if you want to talk about, I guess, sort of the aspects of the economy that are most highly intersected or intertwined with freight movement, supply chain, et cetera. And then we can drill down from there.
Okay, great. Let's do that. So I want to start first by going back a little bit in time. A few years ago,
Yeah.
we had extreme supply chain problems. The ports were clogged up, with in some cases over 100 ships waiting, up to 6 weeks to be able to get to a berth. Some ports struggling to get any business because the ships would dump everything at the first port of call, turn around and head back to Asia or wherever they were getting the imports from.
Mm-hmm.
It was difficult on the water side. The ports got loaded up with containers that had no place to go because the local distribution centers were absolutely stuffed to the point where importers were renting trailers to store their goods in because there just wasn't any room at the inn. The distribution centers were absolutely stacked ceiling high. So it took some time to kind of bring that under control.
Mm-hmm.
Consumer spending stopped growing at 20%, which is what it was doing starting in 2020 for about a year. Thank you, Uncle Sam, and trillions of dollars of stimuli. And during that period, companies were asked, by Wall Street analysts, by the board of directors, by others, the press, what are you doing about your supply chain? And they talked about holding more inventory. They talked about holding more inventory in more places. So there were, coping strategies that made good sense. But as the effect of COVID started to wane from the economy, the pressure to spend good money to hold extra inventory to build more distribution centers and in a broader regional network,
Mm-hmm.
all of that push went away. And then just about as it did, the Houthis in the gang of rebels in Yemen started shooting at ships going through the Red Sea, and basically a lot of companies that had backed off their supply chain risk management strategies, suddenly were asked, well, how are you doing on this? So, very crazy, guidance from people in finance, Wall Street. One day they want you to spend the money, the next they don't want you to.
Yeah.
So what we've seen is that in the last 3 to 4 months, and this is just following the Logistics Managers Index, which
Yes.
about, and I think the listeners to these podcasts, if they don't have a subscription to it, they should talk to you or to me, and we can get them connected, to Dale Rogers,
Yeah.
that Dale Rogers leads. So anyways, bottom line is that inventories have not only been replenished, but they are actually higher than a lot of companies would normally have at this point. And the main reason for it is pretty simple. You look at the chaos that having to send ships around the Cape of Good Hope creates, right? We would have had excess supply of ships and ocean carrier rates, down, at about $1,000 a box from,
Mm-hmm.
China to the U.S. West Coast. Well, the fact that all these ships get tied up on their voyages to and from the western part of Asia by another, minimum of 10 days, to practically 20 days, means a lot of the ship supply has been absorbed, and rates have shot up a lot. We're not back to where we were during COVID, but in some cases, we have heard of people paying spot rates well north of $10,000 coming from Asia to the US.
Mm-hmm.
So, but that seems to have simmered off. We're seeing now that the rate increases are really small now. And in other cases, we're seeing declines in rates. And what that tells us is it tells us exactly what the Logistics Manager Index implied back in June, that we were where we needed to be, and it had expanded for 7 consecutive months, and now we're seeing companies in public, when they get asked about their inventories or other operational issues, they say, no, we're very happy. We have restocked, and we've overstocked where we think we need to in order to be able to maintain products on the shelves. They're still going to be bringing goods in during the rest of the summer and into the fall. There's no doubt.
Mm-hmm.
But that frantic pace at which they were doing it, I think that's pretty much over with. And so we'll see, uh, the ocean costs coming down.
Yeah, so it's fair to say then that when we address inventories, Walter, that things are in a much better place than they were. We're not talking about bloated inventories anymore like we were all that not that long ago, or stretch or inventory stretched too thin. Like it's kind of it's a much better situation now. Is that fair?
Ex- Very, very fair.
Okay.
I hear companies like Home Depot talk, and Walmart and others, and pretty much across the board, you're hearing that uh, things are where they want them to be, which is
Mm-hmm.
great.
Okay, terrific. So let's shift gears for a few minutes, Walter, over to inflation. Obviously, the Federal Reserve has the 2% goal at top of mind. Um, there's a lot of talk that maybe they've overplayed their hand and have waited too long, and then we may see multiple rate cuts between now and the end of the year, with obviously the objective of helping to get down to that 2% benchmark. And we also saw United States unemployment rate climb a bit in its most recent reading. Um, put all those things together for us in terms of what we may be looking at, what may be in store, and what the current or present impact of all that is with the supply chain focus, please.
Okay, so let's go to the unemployment numbers, because those came out last week, and so we've slowly climbed our way up to 4.1%.
Mm-hmm.
We had dropped as low as 3.5%. And I can tell you that, 3.5% is an indication of a serious labor shortage. It's a 3.5% is a sign of an overheated labor market.
Mm-hmm.
We know why it was so strong. What a lot of economists seem to have neglected is spending on construction for new manufacturing in the US has increased sixfold from where it had averaged the previous 10 years before the 2022 signing of the Inflation Reduction Act. And so even though the Fed raised rates enough to cause a recession, and that's what Mr. Powell said he wanted, he didn't get his recession. Economists who forecast a recession got in trouble.
Mm-hmm.
Now, the risk of one was elevated, but so much money got pushed towards building new factories and plants, like Intel's chip plant, the Hyundai, electric vehicle plant, here in Georgia, a lot of construction like that. And so that offset the negative impact of the monetary policy. So one thing everybody has learned, even the White House, they had their economists write a paper on it, is most of the inflation that we saw in the last few years came from the supply side, not from the demand side.
Sure. Yeah.
If supply doesn't keep pace with demand, then prices go up. That's how a market economy works. And so we watched, the supply side struggle to catch up. We saw the government give tons of money to ports and railroads and other places to improve our infrastructure. And between that and the end of COVID, we've seen the pressure in the labor market and therefore on inflation really come off. Inflation, which peaked at close to 9%,
Yes.
it is now down to 3.5%. We know 2% is the stated goal of the Federal Reserve. What you never hear is anybody ask the Fed why 2%. And as far as I can tell, the reason for it is Milton Friedman, the Nobel laureate in economics,
Mm-hmm.
wrote a paper decades ago and said that we need a little inflation to help the economy, but not too much. And so, the central bank should be increasing the money supply about 2% faster than the nominal GDP growth rate. And that would help stabilize inflation. Well, that didn't work. Especially in the 70s, we had that horrible bout with inflation. And the problem is that, and this is, something that economists really need to think about, is the 2% goal basically assumed that the inflation came from the demand side of the economy, because only demand can move fast enough, economists thought, to cause inflation volatility. But Jeff, supply can do the same thing.
Mm-hmm.
And if you don't have enough, if you're importing a lot of the goods that you consume and the ports are struggling to be able to handle the volumes, the cost of buying and moving goods is going to go up, and companies have to pass that cost on. That's how the supply side contributes to inflation.
Well, I understood, and that's a really interesting point, Walter, because as you were laying out that scenario, you can't help but notice when you look at import volumes, especially for the big West Coast ports. I'm thinking Los Angeles, Long Beach. They're hitting really strong import numbers. And obviously a lot of that is seasonal based, holiday stuff, back to school, what have you. But all that freight is coming in, all that cargo is coming in at a time when we still have very weak demand, generally speaking. I guess I'm talking from a truckload perspective, but is there a way to sort of size up or figure out, hey, we have these high import numbers coming inbound, we also have a ton of excess truckload capacity and not a whole lot of tonnage or volumes moving on the highways. Some for people thinking about that type of thing, how would you explain that to them?
No, I would say that that's an indication, that consumer spending isn't as strong as some in the press were making it out to be.
Right.
Yeah, in fact, there was a lot of confusion about what the higher import volumes mean, and so let's go talk to the purchasing managers at the big importers.
Mm-hmm.
And what they will tell you is they place their purchase order now in about on average 7 months, the stuff that they ordered will show up in containers at a port somewhere in the United States.
Yes.
So there's a serious lead lag relationship, uh, that exists in the supply chain that most analysts somehow seem to ignore, or economists seem to ignore. We live in this instant gratification kind of world.
Yeah.
You turn on TV and you can watch any movie that's ever been made up to that date. You can watch reruns of shows that you missed. I mean, it's great, and so you can watch interesting TV the minute you sit down. We've got fast food restaurants galore. It's too much. That's that kind of instant gratification. Well, unfortunately, when it comes to supply chains, nothing's changed. You still place your order. The producer is going to have to go get the raw materials, assemble them someplace. Then they're going to have to go make those millions of widgets that you ordered, and then they got to go find boxes to stick them in, and then get them onto a ship.
Sure.
And then,
Absolutely.
yeah, and then the ship still loses, somewhere between 2 to 4 weeks showing up at the port in the U.S. So that's what's going on, and so there's a lot of confusion about uh, the timing of everything.
Okay, understood. And just with the couple minutes that we have left, Walter, let's take a quick look at two separate topics. One would just be the ongoing, what I guess I will classify as a manufacturing slump. You had just talked about purchasing managers, the Institute for Supply Management's manufacturing reading came out late last week, and it once again was under the benchmark goal of 50. And I think it's been under 50, something like 20 of the last 21 or 21 of the last 22 months or something like that. So clearly manufacturing is kind of hurting right now in that respect, especially when you contrast it with the services sector, which really blew up when everyone started uh getting out of the house again after the pandemic. But are we missing am I missing anything with the manufacturing downturn? How do you view that?
No, I listen. I agree with you. Let's see. What do we manufacture stuff for? Well, we manufacture stuff for houses. How are housing sales doing? House
Yeah.
prices are up a lot because of the Fed's monkey business with the interest rates.
Yeah.
But although house prices are up a lot, the actual sale of houses, the starts of construction of new houses, those are way down.
Okay.
If you're a manufacturer, who sells into the residential real estate market, or into the office real estate market, um, you're struggling. Okay, so that part done. Let's look at consumer spending. Well, consumer spending isn't growing like it was before. It has stayed high after that big surge starting in 2020, and it hasn't really mean reverted back to some kind of a trend level. I've been waiting for that to happen for some time. I'm sure the CEOs of the big retailers are also worried about it. Um, and so, if we see continued weakness in the labor market and consumers continuing to rely on credit cards and other forms of debt to support their spending, this will come to us to an end pretty quickly. My guess is the Fed will be too slow, as it was. It was too slow raising rates to fight inflation, and when it comes to avoiding a recession, the Fed will have proven to be too slow about that as well.
Okay.
Again, I don't think Mr. Powell has the qualifications to be a Federal Reserve chairman.
Okay.
He needed to be removed and a proper professional put in his place. But what can you say? I worry about a recession in 2025, but my worry index is still just slightly above average.
Okay. All right. Well, we'll
Let
take
me,
that.
let me just add one thing.
Yeah.
The yield curve is inverted. And when the yield curve inverts, a recession doesn't happen. But the minute it starts to uninvert or it becomes uninverted,
Hmm.
by the Fed, cutting rates a lot, that's usually when the recession starts. I've got charts in that I'm happy to share with anyone, you know.
Okay.
So so it looks like 2025 could get dicey.
Understood. And just to wrap up, Walter, can we talk a little bit about cross-border logistics between the United States and Mexico? You can't help but notice how many logistics services providers are establishing or increasing operations there, sort of in not in preparation, as it's already happening. You hear a lot more about cross-border freight and Mexico obviously being our number one trading partner now for the first time in a long time. And also, what does that mean for the United States business relationship with China?
Yeah, well, basically, a lot of the reason Mexico has surged is because Chinese companies took a page out of the strategy book of the Japanese companies. In '87, Reagan raised tariffs on Japanese imports, especially electronics and tools, by
Hmm.
100%. And over the next 7 years, Japan's share of our imports dropped from 24% to 12%. And what Japanese companies did is they moved their final assembly plants to other countries that didn't have such a high tariff with the U.S. For example, Korea, Taiwan, Hong Kong, Singapore. Right back in the '90s, we talked about the Asian tigers. Well, the Asian tigers were benefiting from the fact that the U.S. slammed Japan very hard, and the Japanese companies left the final production to the quote unquote Asian tigers.
Okay.
And so what happens is those goods went to the US kind of tariff free. So the Chinese companies see that there was, with NAFTA 2.0 or whatever the name is of the second agreement,
Yeah.
uh, you have very, very low tariffs, if any at all. So go do your final assembly in Mexico and put stuff on trucks, trains, and ships and shoot it over to the US.
Yep. Okay.
The more Chinese companies set up shop in Mexico, the more everybody gets used to what do you have to do in order to accommodate it. And I'd say the logistics industry in Mexico is getting great at it. UPS just acquired the largest logistics and trucking company in Mexico. I forgot
Hmm.
the name, but that's if that isn't a clear indication, I don't know what is, Jeff.
Yeah, I think it's called Estafeta, if I'm not mistaken. You talk about, I think it recently happened at that Mexico announcement right prior to their earnings release, which was last week or the week before. Yeah, so it's a pretty good indication when a company like that is making that type of investment south of the border. Is that fair?
Oh, absolutely. And then you look at Laredo, and I mean, everywhere as you turn, there's another distribution center, cross-docking facility going up. Laredo is I think at this point the largest U.S. port.
Hmm. No doubt about it. It's very interesting, and it's certainly going to require a watchful eye going forward. Look, Walter, it's been we're at the allotted time for today's podcast. So, on behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, I want to offer up a big thanks for spending some time with us and joining us again this time.
Well, thanks for having me back, Jeff. You take care till we speak again.
Absolutely. And for those of you in the audience that would like to subscribe to our podcast, but that perhaps are not yet at this point, just go wherever you get your podcast. Look for Supply Chain 24/7, and it will pop right up. And also, if you're on Twitter and care to give us a follow, just simply look for Logistics MGMT. Thanks, everybody. Have a great day, and we'll catch up with you next time.